Good morning and welcome to another edition of the Main Management Weekly Market Note. I'm our head of research here, Alex Varner, alongside
James Maxwell, SVP of Research.
This is our market note for the week ended March 20th. As usual, our offerings, ETFs, by WTMAT, SECT, INTL, all available wherever you can trade single tickers. On the performance side, a lot of red here. I think the markets don't like the war. Is pretty simple. They're pricing in, at least as of last week, higher oil prices feeding into inflation off of the high PPI print that we'll get into. But long and the short of it is, on the trailing week, commodities were up 1.9. Euro was down the most at 3.1. The Euro Stoxx 50 for the ETF. The sectors and the S&P, energy was a leader up 2.8, and then financials up 0.4, while the laggers were utilities down 4.9 and materials down 4.5. Year to date, energy, wow, 33% up, while the next best is consumer staples and utilities at 4.6. And then financials are the big laggard at down 10.4, and consumer discretion down basically 10%. On the recession dashboard, not a ton has changed. We're looking at some maybe changes as the month rolls over here, more on the inflation and employment side. We'll see. We got the Fed meeting last week. That doesn't necessarily drive our decision, but it certainly is one of many inputs that we take into consideration here. On the FOMC, speaking of, as expected, they left the Fed funds rate, target rate unchanged this week at 3.5 to 3.75. There was one lone dissenter, that was Moran, down from two dissenters in December, but he wants a rate cut. The dot plot on the left shows you that one 25 basis point cut is forecasted for each 26, 27, and then no cuts in 2028. It is worth mentioning this is kind of pre-war, as it's now being called. These are all came out and were kind of codified before the war started in earnest. So they are a bit dated and things clearly have changed since then. The good news on the right there, you can see the summary of economic projections. From December's reading to March's reading, GDP is forecasted up from 2.3 to 2.4. 2027 was lifted from 2.0 to 2.3. So you saw good increases in GDP. The problem is on the other side of that, you saw increases in inflation, both headline PCE and core PCE. The headline figure went from 2.4 to 2.7, and the core, which is the Fed's stated preferred inflation measure, went from 2.5 to 2.7. So those are not so great developments. I think that's probably only been confirmed by the higher oil prices that we've had. Again, there's the issue of, all right, how long lasting are they? Do they have time to feed into the inflation prints in a meaningful way? I think with today's action, you've seen Trump come out and say, hey, we're getting closer to an end game. But then again, oil swings 10% anytime something comes out over the last week. If all of a sudden it looks like straight and forward moves and the war's going to be a little bit longer, oil's up 10%. If somebody comes out on the tape and says, hey, things are looking and wrapping up, it's down 10%.
The other thing I kind of took away from the presser last week is the Fed really doesn't have that crystal ball to try and forecast how higher oil prices are going to impact inflation. Like, they're supposed to, in theory, look through any sort of one-time shocks to energy prices. I mean, that's why they're looking at core PCE, for example. You're excluding.
That's why they look through tariffs when they're
you're supposed
to one-time thing.
Look through these one-time things. Is that actually what they do? It's not exactly clear. I mean, if you look historically at other times where energy prices were kind of higher off of the spikes, they kind of do look at those. They're not completely immune to looking at those oil prices. So I don't know. It's hard to say exactly. I mean, something Powell kept saying was like, we don't know yet. It's uncertain. We don't know. We don't know. Just like everyone else.
Yeah. And they are data dependent, so they'll wait and see. He did mention that the risks to the labor market are skewed to the downside, which would call for lower rates or rate cuts like Moran wants. However, if it's inflation that gets pushed through the higher oil prices, then risks to inflation are to the upside. You saw that with hotter PPI prints as well, that we'll get into. But that will call for higher rates, and that potentially leaves the Fed in a difficult position where their dual mandate is being pulled at both ends in separate directions. I'm glad I'm not on that, not on that committee. On the inflation expectations, again, as James just said, the commentary around developments in the Middle East is uncertain. The effects on the U.S. economy, we don't know what they will be. Even as oil prices have risen, kind of dramatically in rise to the conflict, they're now back down 12% a day. It's hard to write these when things change by the hour. But the committee still expects inflation to return to its long-term target of 2% by the end of 2027. We'll note that core PCE hasn't been below 2% since March of 2021 and has averaged 3.84% on a year-over-year basis since then. So we've been running considerably above. And again, this is a long-term average, so it kind of depends on how far or how long you want to define long-term as, because for a long time prior to 2020, we were running below 2%. So do you include the 10 years between the GFC and COVID? It's now been 6 years since COVID and the rate hikes in 22. It kind of depends on how you take the average.
However you want.
You can really cut this data to be wherever you want it to be. But basically, you see the distributions at the bottom there, the projections for the participants' core PCE inflation figures for 26 and 27. Expectations increase materially for 26, 2.5 to 2.7, while on median, the expectations come back down to between 1.9 and 2.2 for 2027. So they are expecting this to move through by the end of 2027. I'm not going to reopen, the transitory versus temporary.
I don't think they want to use that word again.
We're not going back there. But anyways, kind of keeping on that inflation note, we got the producer price index, which came in above forecasts again in February. The headline index jumped 0.7% month over month. That's on the left in light blue there. That's the biggest monthly increase since July of 25 and more than double expectations for a 0.3% rise. The headline is now up to 3.4, call it, the highest since Feb of 2025. Core PPI retreated a little bit from January's spike, but it was still up 0.5% month over month. Also above forecast for a 0.3% increase. And then year over year, it's up to 3.4, which is the highest since January of 2025. Again, this is pre-war, so these don't have any of the energy price increases baked in or into consideration. So that is a concern where we've seen these energy prices rise, and we yet to have data kind of revealing how they feed through to the headline figures. But at the time of this, this should encourage the Fed to keep rates unchanged because you don't want to cut rates into a rising inflation. And again, we'll see kind of where their focus falls if the labor market starts to materially deteriorate or inflation starts to materially pick up. We'll see where they kind of prioritize.
There's also part of it, and this is kind of the calculus the Fed has to deal with as energy prices increase. It's this tax on the consumer is a way to think about it. Your gas is more expensive. That ends up feeding through to food and everything else that's dependent on energy. So much of what you're buying. And there's kind of this calculus of, okay, how much of it is inflation? And then there's a point where it starts hurting the consumer, and that maybe down the road, that consumer gets hurt so much, they're losing their job, or the labor markets get impacted, or the overall economy gets impacted. So, how do you balance inflation and obviously the Fed's mandate of inflation and unemployment? That gets really, really complicated with rising oil prices.
And with the oil prices, they're talking about, okay, how long do they have to stick around? How high do they have to be in order to start to see a demand destruction?
Yes.
Because right now the demand appetite has been fine. Because most people are like, all right, this will work through. But if they stay higher for longer, then you start seeing demand get reduced materially, and that then spurs fears of a recession.
And in 2022, you had this similar dynamic, but the difference was you had a really hot labor market going into that. You were at it's kind of post-COVID euphoria, a lot of the stimulus checks, all of that.
Wage increases were still running hot.
High savings, all of the really strong consumer balance sheet. It's not weak per se now, but it's less strong than it was in 2021.
It's normalizing.
So you're starting to get a lower base or more normal base.
That buffer is kind of reduced there. On the food and goods PPI, that PPI number has been driven mostly by goods rather than services. PPI for food jumped 2.4 month over month, the most since May of 2021. Year over year, it's still down at minus 0.2%, but we don't think that might not last very long. Might be back positive here. Food and fish and dry vegetables were up 50% month over month. I am not sure exactly what drives that. We have to take a deeper look in there. On the right, you can see the goods PPI. Food clearly fed into this. That goods number was up 1.1 month over month. That's the highest since August of 2023, and it accelerated to 2.5 year over year. So, this is similar to the CPI, where you're seeing goods kind of be more inflationary. You talk about the tariffs. That's what the prices are more easily adjusted on rather than services, which are a little bit more nebulous as far as like price increases. On switching gears a little bit to industrial production, it was up 0.15% month over month in February. Fourth straight gain, and the longest since the first 4 months of 2023. So good to see this kind of begrudgingly almost moving higher. Manufacturing output was also up a similar 0.16%, both beating forecast for 0.1. On the right, you can see the indices. Those are the thicker lines. And then the year-over-year figures are the slightly thinner lines. But the indices are grinding back higher. The industrial production index is at 102.6. Its highest since August of 2019. So that's solid, like a 7-year breakout there. The output index is up to 98.3, the best since May of 2022. And they both kind of tick down on a year-over-year, but still appear to be in that choppy acceleration. So again, and this feeds into some of the regional Fed stuff we're seeing is the PMIs where it's modest expansion. It's not robust, but it's just going in the right direction, slowly, steadily, kind of steady Eddie. Better this than the deterioration.
This is kind of your one of your bull cases or talking points on there is broader kind of manufacturing, industrial production is going to offset some of the more of the weakness or hurting from higher oil prices.
Yeah. On the capacity side of things, again, there's a numerator denominator to this. We've touched on this before, but nonetheless, total capacity utilization up to 76.3, and for the manufacturing sector, it's up to 75.6. We've looked at the high tech components; those have come into a little bit more focus with the semiconductors, AI, hyperscaler, capex, that sort of stuff. But basically, they're all solidly positive. Only computers and peripheral equipment was down on a month-over-month basis. On the right, we show the year-over-year, just for clarification. But, semis and other components lead the way up 10.3 year-over-year, while communications equipment lags at 3% year-over-year. But again, all solidly positive. I like to see that continue. We can kind of see that solid, lift across the board there starting in mid-2023. On the factory orders, those were up 0.15% in January, month over month, in line with forecasts. On a year-over-year, they ticked down to 4.4, but basically still on that choppy uptrend. Similar for kind of factory orders, transports. Transports tend to be quite volatile. And those, posted a stronger 0.4% month over month reading. So kind of the transports were a drag on the headline figure there. But that's 3 months in a row up for the transports, and then year over year is up 1.4, the best since July of 2025. An example here on that, kind of volatility within transports is defense aircraft orders plunged 24%. You might see that ramp back up as we've hacked a random, like, oh, we need more aircraft. Let's purchase some more aircraft. So that's, that transport number is pretty volatile. On the kind of dollar basis, both of them are solid. They're the transports are grinding higher. They're the highest since October of 2022 at 507 billion, basically. And then total factory orders are at 620. They're only 3.5% below the all-time high from May of 2025. And then on the right, you can see the year-over-year readings. Again, similar to that industrial production manufacturing. These are kind of similar, industries, but grinding higher on the year-over-year basis. So good to see there. On the other hand, we saw new home sales, which fell out of bed in January. They dropped to 587,000 units, the lowest since October of 2022, and are down 11.3% year over year. They're down 23% from the recent cycle high of 764K. That's just 2 months ago, or not 2 months, 2 readings ago. This is pretty delayed. They're in January. Bad weather was cited as the primary culprit for this, so hopefully you'd see a rebound in that come February and maybe March. And then the month-over-month figure, just worth noting, it was down basically 18% month-over-month, and that's the biggest monthly decline since July of 2013. So some pretty outlandish readings here due to weather. On the pricing side of things, you can see on the left there, that dark blue line is the median new home price. It's down to $400,500. It's been trending lower over the last few years. It's down 13% from its peak, which was in October 22 of 460,300, and it's down 6.8% year over year. So, that's softening in prices is good. You want to see that helps. Again, it's not great for sellers, but you can see what sellers were dealing with prior to COVID was 300,000. Now they're at 400,000. So they've seen a solid increase. So I don't feel terrible for them. And honestly, we need more buyers to be in the market in order to help loosen this thing up. But the combining the volume of sales on the prior slide with the price, you see that the total value of new homes sold fell to 235.1 billion in January, lowest since July of 22, and down 17.3% year over year. It's the most negative since Jan of 23, and it's also down 32% from the peak back in October of 2020 of basically 350 billion. In the last 2 readings alone, it's lost $74 billion, or 24% of that value of new homes sold. Silver lining, perhaps those lower prices will coax buyers back in, but cold weather clearly having a bad effect on this.
One thing on this, obviously this data is through January. That hasn't reflected in, I keep going back to this, the oil prices, the increase in rates because of those oil prices, higher inflation. that obviously feeds through to mortgage rates, which have moved back up, I think, around 6.5% now. They were near,
They were
low
six.
sixes. Yeah, low sixes in January. So certainly that doesn't help on the anything regarding the housing front.
Yeah. So we'll see as this continues to unfold. Again, pretty severely lagged data here.
Yep.
In summary, the FOMC, left rates unchanged as expected. GDP revised up, but so was inflation. PPI came in hotter than expected for a second month in a row. Again, pre-war data, so we're your ongoing concerns of inflation continuing to run hot as energy gets now picked up into the March readings. Industrial production, manufacturing output chugging along. Same with factory orders chugging along, better up than down. And then new home sales dropped off of the bad weather. This week is kind of last week was a lot of data with the FOMC as well. This week is a little bit less. Construction spending. You do get productivity tomorrow and Tuesday. Unit labor costs. That's kind of the big piece. Import and export prices, and then you get the final reading from Michigan consumer sentiment. We'll see how people are feeling. Maybe they're a little bit happier with the NCAA tournament going on, or maybe they're sad because there are no more perfect brackets. Once again, Kalshi's off the hook for their $1 billion payout. But I think Florida getting taken out took out a lot of, at least in our pool, I went from like 15th and shot up to like 7th or 8th when Florida went down, just on the basis of pure potential numbers. So we'll see. Depending on who you're rooting for, you probably either had a good weekend or a terrible weekend. But thanks for joining us, and we'll talk to you next time.
Thank
Take
you.
care.